Welcome to Hardman Talks, and today we are going to talk about Chesnara's 2022 interim results. We're joined by Steve Murray, who is CEO, and Dave Rimmington, who is Finance Director. Welcome to the webinar, gentlemen. We're going to start with a brief presentation by Steve, and then we're going to follow that with a Q&A afterwards.
Thanks very much, Brian, and good to be talking to you again today. As you said, I'll give a short presentation, just of a few minutes, and then we'll have the chance to have a Q&A together. I thought it was worthwhile just reminding people, as some of you might not have heard of Chesnara before, so who are Chesnara and what do we do? So we floated on the stock exchange back in 2004. We're a European life and pensions consolidator. We operate across 3 markets, so we're in the UK and also Sweden and the Netherlands as well. And our main focus really is on managing in-force books of business. We've got 2 closed books of business, so that means insurance policies that we don't try and sell new policies around anymore. So we have a UK business that does that, and we've also got a Dutch business called VARD that also does that as well. And we are open to new business as well in the Netherlands and in Sweden. And in the Netherlands, that's predominantly term insurance business, so looking after people's life cover. And then in Sweden, through Movestic, we're looking at group pensions, and also we have a custodian business there as well. And having those different platforms, those different products, and those different opportunities to create value for shareholders, we see as a really attractive part of Chesnara. So when we look at our half-year results, overall, we feel it's been a good period of delivery for Chesnara. On a personal level, I've now been at Chesnara for just over a year. My first 6 months were as CEO designate, and the more recent 6 months, I was then fully approved as the Group Chief Executive. And in terms of the progress we've made, we really feel that we've revitalized the strategy here at Chesnara with a greater focus on growing the business through acquisition and ensuring that that will ultimately deliver long-term growth and a sustainable dividend strategy for our shareholders. The economic environment over the last 6 months has obviously been very, very volatile. That said, against that backdrop, we continue to have very good line of sight to a number of actions that will deliver sustainable cash generation over the long term. Our solvency position has remained strong, and we believe, again, we've demonstrated the resilience that we have here at Chesnara through this market volatility. And we're also focused on evaluating additional management actions that we have available to us that can help to bolster returns. One of the things that we think is unique about Chesnara is that we've got a strong track record of doing M&A over a number of years. And the first 6 months of this year has been another busy period for us. We've completed 2 acquisitions. Those are 2 that we announced last year. And we also announced a 3rd acquisition as well. And we're continuing to see positive opportunities across the territories that we operate in that we're hoping we can take advantage of, not least because we have readily available financial resources that we can deploy immediately. Finally, the other thing I was going to highlight was that we have further strengthened our leadership team since our full year results. We've brought in Amanda Wright as our Group General Counsel, and we've also created a new role, which is a Group Chief of Staff role, reporting to me, for Alistair Loney, who's our current COSEC. And that will really give us further bandwidth at the senior level to allow us to go after some of the strategic opportunities that we're seeing. Turning to the business highlights then for 2022. Overall, as I said, it's been a good year in terms of delivery so far. On the M&A front, we've completed the 2 acquisitions that we announced, and we're firmly in the integration phase now for those. And we've also recently announced the acquisition of the insurance portfolio of Conservatrix, which is our 3rd deal in the last 12 months. When we take all of those together, we expect those to add around 32 million of economic value to the group and around 10 million to the annual steady state cash generation of the group as well. Looking at the financial results, we've talked to the market before about the fact that Chesnara has delivered in a very wide range of market conditions over the last number of years. And we've again seen that delivery as part of the first part of this year, with our divisions generating commercial cash of 18.6 million. In terms of that cash metric, that also strips out some of the large movements that we've seen over the period from the symmetric adjustment, which is in effect a shock absorber which works within our capital models and takes the heat out of equity market falls, but also ensures we hold more capital as equity markets grow. And we might cover that in more detail as part of the Q&A. Our solvency has increased to 195%. That's largely driven by the Tier 2 bond issuance that we had back in February. As a reminder, that was 200 million. And as part of that, we now have an investment grade rating from Fitch. And if we look at those resources, that means that we've got surplus available as well as cash resources to deploy immediately against future acquisitions if we see them. The group's economic value has been impacted by the sharp market falls that we've seen, but the fall in economic value is very much in line with the sensitivities that we published as part of our full year results. And we believe that exposure to equity markets still provides attractive returns both for our policyholders and our shareholders. The commercial new business has been steady at 4.6 million, and that does add to the long-term value of the group. And finally, and importantly, we've yet again increased our dividend by 3%. That's for the 18th year in a row and continues that 18-year unbroken track record of dividend growth. I finally just wanted to touch on the strong fundamentals that we have at Chesnara. We remain in a really strong financial position, and we've got strong fundamentals on which to build on. I wanted to remind you that we do three things here at Chesnara. So firstly, we maximize the value from our in-force books of business. And post the acquisitions that I talked about earlier, we'll have over 1 million customers across the group for the first time in our history. And we see real benefits from that additional scale. And we've also got the expertise to deliver further value, either through delivering cost synergies and capital management actions that come alongside these acquisitions. And we also remain focused on evaluating further actions, including the updating of our investment strategy. Secondly, we seek to execute value-adding acquisitions of both portfolios and businesses. And our strong financial position allows us to continue to fund small to medium-sized deals from our own resources. And the recent activity that I've just highlighted demonstrates that M&A part of the strategy really has been revitalized. And finally, we write focused new business where we've got a high degree of confidence that we can make a profit. One of the things that we spoke to the market about in the full year is that we were continuing to see some high transfer out rates from our Swedish business. And one of the things that's been pleasing at the half year is we've seen that transfer rate come down, and that now actually sits below our long-term assumption for lapse rates in that book. And what we've also seen in July is some legislative changes in Sweden, which should mean that there's a broader set of policies potentially available for us to transfer into Movestic. So overall, we think it's been a good start to the year and a good start in terms of delivery. After a year at Chesnara, Brian, I continue to believe there's a lot to look forward to here at Chesnara. So I'll maybe hand back to you, and I'm sure you'll have a few questions for us.
Thank you very much, Steve, for that introduction. I do have quite a few questions, as those who know me won't be surprised to find out. So we're going to dig into some of these things that you mentioned in a bit more detail. And I think what we wanted to start with is perhaps the economic background, because I think we've been in what some people might call a dramatic period, or you sort of refer to the market volatility, and equity market weakness has been one of the strong features. So you mentioned it's had an adverse effect on economic value. It hasn't affected cash generation so much. And I just wanted you to chat through a bit more about why the dynamic is different for these.
Yep. Dave, do you want to cover that economic background in a little bit of detail? I think particularly, Brian, because we have, I suspect a lot of people watching might be accustomed to what they've seen in the UK, but it's important, I think, for us to talk through what we've been seeing in Sweden and the Netherlands as well, and then we can talk about how that's impacted ECV and cash. So Dave, over to you.
Yeah, okay. Thanks, Brian. Yeah, so I'll go through the economic conditions and then talk about how they've impacted economic value and cash, and explain why the impact on those two metrics is quite fundamentally different. So as Steve mentioned, if you just start with equity markets, I mean, across the board in all our territories, equity values are down, but the Swedish OMX all-share index is down 29% in the first 6 months. So a huge drop in comparison to the FTSE all-share of -6. And that's the Sweden is the part of our business most exposed to equities because it's got a large unit linked portfolio. So it's worth bearing that in mind. Interest rates have gone up in the period. That's generally good news for cash generation. Credit spreads have widened, and that has a negative impact on both cash and economic value. And then finally, inflation. You know, as we all know, inflation's high across all of our territories, particularly in the UK. We're not seeing a huge amount of inflationary pressure on our actual cost base at the moment. So it's not burning through to our actual costs, but we have increased our long-term inflation assumption to 4.5% in the UK. So explaining the impact of those market movements, well, economic value effectively values all the future cash flows from our in-force book from the market value at the close of the period. So when the equity markets fall, you effectively assume no recovery, and therefore all your future positive cash flows coming in are assumed to be lower. So you get this big mark-to-market impact when equity markets move. In reality, we would expect equities to either recover in capital value or at the very least give real-world returns above risk-free. Mm-hmm. So that's the reason our equity markets have such a big impact on economic value. So why don't
and your core assumption is that, well, this is what Solvency II kind of dictates, is that your core assumption is that equity markets produce a risk-free return, isn't it?
Absolutely, yes. So the economic value we report at this period end assumes no market recovery and nothing but risk-free returns. And clearly, we all expect a level of recovery and returns above risk-free. And we talk later about where we see future sources of value over and above the reported economic value, and it's exactly this type of dynamic you refer to, Brian.
Yeah, and it's maybe worth mentioning. So equity markets we know have been weak. There has been a slight bounce back since June. Presumably that has helped a little bit.
Yeah, kind of changes by the day. But last time we checked, you know, we're estimating about 10 to 20 million of the economic losses in the first half of the year would have recovered. So I think that's not so much about the value, but it just indicates the principle that this is a temporary issue to some extent, and we know, if you believe we're of the view that the equity markets were at a particularly low point at the end of the accounting period, you would expect a level of recovery thereafter.
Yeah, and credit spreads, I think, have a similar dynamic in the sense that you lose value as they go out, but you gain it in returns in the future. Is that right?
Yes, and so credit spreads impact both cash and economic value because you do get a deterioration in the actual market value of your assets, but you don't get a corresponding reduction in your liabilities that you get when interest rates rise. So interest rates rising is an interesting dynamic because that has very little impact on your economic value, but is positive for cash because it reduces your long-term liabilities.
And you also touched on inflation, and I think inflation is one of these topics that investors are very concerned about, and certainly everybody seems to be concerned about. And the news headlines are full of individuals and some companies sort of experiencing the problems with these. You mentioned about costs. So how does inflation actually directly affect Chesnara?
Over half of our cost base relates to salary costs, so that's the most obvious area. So wage inflation would be the most obvious impact. What we've done, we actually did it mainly at the last year end, we did strengthen our long-term inflation assumptions to, in the UK, for example, to just above 4%. What we might be exposed to in the short term is a period of wage inflation higher than that. We don't know that to be the case, but but it's clearly a risk. We've given a feel for the scale of those type of inflationary exposures. And I think I characterize it as they would have a material impact, but nothing that is so fundamental that it would have any kind of long-term lasting damage on the economic value.
Okay. And one of the things that when we spoke about earlier was M&A is bringing, one of the benefits of M&A is improving unit costs. And I think, Vard was by far and away the smallest business within Chesnara, and the latest acquisition is going to significantly add to its scale. Sanlam obviously increases scale in the UK as well. How far do you think you can improve unit costs?
Well, it's interesting that because so in Vard we've done a number of deals, over the last 2 or 3 years. The two announced in this year being the latest two, and actually central overheads have been maintained at the current level despite all of those acquisitions. So there's been no knock-on impact from the increase in the scale of the portfolio so it's almost 100% synergy. I think ultimately, if you did something more transformational in size, another deal, you might to some extent start to see an increase in your overheads, but it wouldn't be proportionate. So we're really confident that the dynamic of sharing fixed overheads across a wider portfolio is very much happening, both in the UK with the Sanlam deal and in the Netherlands.
And looking forward, I think one of the concerns that people have is we might be going into a recession. And while every recession is different and causes and effects, should that happen, how do you think that might affect Chesnara?
Yeah, I suppose in a way the direct impact on the business, because as Steve said, we do write new business, but it's not a huge part of our financial model. So we're probably not exposed to some of the more traditional elements of recession of reducing consumer demand, because we don't we tend to manage an in-force portfolio, so it's here already. So I think the impacts of recession on us would be more about the impact it has on the economic environment. So, for example, if equities would continue to fall, we would see the dynamic we've seen in this year again. But likewise, if it means interest rates increase, or become more likely to fall further, we'd get so it's more about the second order impacts of the economic conditions than I think the direct impact on our business.
Yeah. And bringing this round, so cash, which is one of the key things sort of underlying all this and what you need to pay the dividend. We saw economic value fall in the first half. Cash still produced a positive result. Why does cash behave differently from the economic value? So probably just a reminder here, Brian, that we define cash generation as in essentially the movement in the Solvency II surplus. So there are two factors which influence it. It's both the value of the company, which is kind of economic value, but on a technical own funds basis, and the capital we have to hold as a company. And quite simply, what we see in the period is whilst the value of the company has declined due to the economic conditions, the capital we have to hold has declined by even more. This is because there's two things. As equities fall, your base level of capital you need to hold against that gets smaller, but also there's something called the symmetric adjustment, which at one level is very complicated, but at simplest level, as Steve says, it's kind of a shock absorber, which basically is baked into the Solvency II rules and says, after periods of sharp equity fall, you can release some of your capital, i.e. hold less capital, because the logic being the risk of further large fall is reduced. So what we've seen in the period is a really sharp reduction in our statutory capital requirement, which is more than compensated for the reduction in the long-term value, and hence widening that surplus and hence generating cash. It's probably worth adding this symmetric adjustment gets built up when times are good. So in the last couple of years, you've been building that symmetric adjustment up. And importantly, we're very conscious that the symmetric adjustment over time reverts to the mean, and it's a shock absorber. So that's why we do report commercial cash, which strips out the symmetric adjustment to leave what we think is a slightly more meaningful view of how much business we've generated from the operations themselves. And it's probably worth just saying for a moment about how the cash generation relates to the dividend that you're paying.
Okay, so two angles on this. The cash results in our divisions influence how much dividend they can pay to the parent company. So as the solvency surplus increases, as has been the case in the first half of the year, that enables our divisions to have the capacity to pay dividends up to parent company. So we're in a really good position, because having generated 60.1 million of base cash in the divisions, everything else being equal, that bodes really well for dividend flow. From a group point of view, as long as that dividend is coming into the group from the divisions, we're confident, therefore we can fund our dividend strategy to our shareholders.
Mm-hmm. Yeah, excellent. So, and that does look very healthy, as you say.
Yeah.
Especially given the harsh environment.
Yeah.
What I'd like to do now is turn to M&A. So I think we're going to return to Steve on this. As you said, you had an active first half in M&A, where you had 2 deals that completed that were announced last year. And then in July, you announced another new transaction in the Netherlands buying Conservatrix. And one question we've had from investors is a bit about the dynamics of that. So Conservatrix is a company that was bankrupt. I hope I'm pronouncing that correctly. And people are wondering, to some extent, how, when you buy a company that's bankrupt, you can still, it's still a good deal, basically. Why is it good for Chesnara?
Yeah. So I think it's important to say that we're not buying the entirety of everything that was bankrupt. We're taking a specific insurance portfolio from Conservatrix. And the reason that this was attractive for investors, as well as the policyholders and staff associated with Conservatrix, I mean, it's important to say this was a situation that happened in 2020. So we have policyholders and staff that have had a horribly uncertain period for well over a couple of years. So look, we were really pleased to be part of bringing a solution there that gives them certainty going forward and ensures that they're part of a well-capitalized organization that's focused on good customer service. So as you might imagine, we looked at those at the insurance portfolios, the capital that we had to put against that risk, then also the assumptions that we made about what we could do around the ongoing cost of managing that book of business. And then we also looked at some potential other opportunities that we might have to look again at the investment strategy within the context of what is a bigger business. And when we ran the numbers, projected cash flow, we felt that as well as being a good solution for policyholders and for staff, that there was a good return to be available for our investors as well. So I think the main bit, Brian, is that the context of that book kind of changes when we bring it into VARD on the operating systems and platforms that we have. But as you've rightly pointed out, these situations are complicated. You know, there were a number of parties involved, and that took a period of time to work through all of that as well. And we were pleased to get that over the line. As we spoke to the market, sorry, we spoke to the market a bit yesterday. There's around 35 million of capital resources that will kind of put against this business. We had a large amount of capital that we'd left in VARD for M&A purposes. So this draws down just over 20 million from that kind of tier 2 debt capacity that we had at PLC, and we're actually utilising a fair amount of the remaining excess capital that we had in VARD. And you can see from the day one impact, look, there's a healthy increase in the ECV, the group on day one as a result of the deal that we're doing.
Mm-hmm. And that capital is there, effectively that's the security in the background for policyholders, and we would expect Chesnara Group to get that capital back over time. This isn't not something you're paying to policyholders or the seller, is it?
That's absolutely right. So in effect, the price for the deal was €1. But as part of that, there was the commitment of us, as you say, to put the right regulatory capital and an excess capital on board of that to make sure that policyholders could have the confidence that there were the right capital buffers, as you see with every insurance portfolio available, and that should run off over time. You know, we'll see the risk margin and things like that coming through as well.
And I understand Conservatrix had some staff. Are they coming across? Are they are they going to be laid off? What's happening with them?
Yeah, they're coming across. Or certainly we're making offers to everybody to come across. Our leadership team, led by Lawrence in VARD, has spent a little bit of time with them. The reaction seems to have been very positive, particularly ending this period of uncertainty. But the fact that we are looking to utilise their capability going forward, we have some resource gaps that we would have been recruiting for in any case across the wider VARD group. So this is one of these situations that it works well for policyholders. versus the other solutions that could have been available to them outside this acquisition. It should be good for staff. It should be good for the shareholders and for VARD itself. It's quite transformational, as you pointed out. It was our smallest division. It's a doubling of the steady state cash generation potential that comes through, and a 70% increase in the policies that they have in force. So it's a very important deal for that division, and for us it creates some further balance in the group when we look across the different divisions that we have as well.
Yeah, and one of the things you sort of highlighted yesterday, when the results were announced, was the sort of prospects for acquisition. So in the past few months, you sort of indicated this is going to be a sort of renewed area of focus, and you provided some idea about the availability in the market and the possibilities of what you want to do in time. So I think there's two aspects of this I'd like to sort of probe into a little bit. One is, so far you have got deals on what seem like exceptional prices, where you have got meaningful economic value uplifts day one. So effectively you're buying these books at a discount. When I spoke with you last year, you sort of thought this might not be sustainable in the long run. But since then, we've got more deals at discounts.
Yep.
How do you see this the dynamic of pricing working out? And I presumably competition plays a part in this as well.
Yeah, it does. I think across the insurance sector, particularly if you look back a few years, people got very fixated on that day one discount to O funds or ECV or whatever the metric was. And I think it was something that people could point to immediately to say, well, look, if the kind of actuarial calculation or the Solvency II calculation gives us this amount and we're paying a discount to that, then that should indicate that there's a good deal. Now the reality is that might be the case, but actually, and Dave touched on this a little bit earlier, what we're really focused on is what the sources of value are from that book over time and the further value levers that are available to us. So we start and look at the totality almost of that commercial value that might be available. And you could imagine then that you would look at that and then say, whether it's at a discount to ECV or not is interesting, but ultimately with a 5 to 10 year view, that's the more important factor that we consider. And we've talked about this Chesnara fan before. That really is just a way of trying to show the areas of value that aren't included in our economic value and what might be accessible. So that's runoff of further risk margin, real world returns, as Dave's talked about, the synergies that are available as well. So don't get me wrong, we're quite happy that those books that have come in have been at a discount. But actually, if I could easily see a scenario where we would be quite happy to say to shareholders, there isn't a discount here, but actually the further value that we can create, how this contributes to the sustainable cash generation of the group, means that was still an attractive deal to do. The final thing I was going to say, Brian, was Dave did a slide at the year end where we talked about our track record of value delivery from M&A, and Movestic was one of the things that investors focused on, where we had over a 700% return from the investment that was made there. Now that was done originally at a discount to ECV, but if it hadn't been, if we bought that at ECV or a slight premium, the return would still have been very, very good. So we're trying to do a little bit more, I suppose, to make sure that investors are aware of those dynamics, aware of the sources of value that are available, and we'll look at value in the round, as opposed to being very, very slavish around one metric. But again, it's a wee bit easier if we speak to people like your good self. It's an easy thing for us to say, well, it's a discount to ECV, but I don't think that tells the full story.
So you've previously indicated that you maybe have about 100 million in existing resources that are available for future transactions, but potentially now you're saying you could do large deals, maybe up to about 500 million. What other resources are available? And presumably to some extent they depend on the circumstances of what you're doing.
Yeah, no, that's a great point, Brian. It'll depend a little bit on the sorts of acquisitions we might be looking at. when we build up those resources, you say, we've again reiterated the fact that, you know, we've got immediately available resources of around 100 million. So for us, that provides either our ability to fund small to mid-sized deals in their entirety, or actually there is cash available straight away. That's almost like the deposit on the house if we wanted to do something a little bit bigger. There is also space within the capital stack. So one of the things that we would consider is whether we would use some of the other. So, you know, tier 2, I think we're kind of comfortable with the amount there, but obviously we've got tier 1 capacity if we decided to use that. One of the things that Dave and the team put in place earlier last year was a revolving credit facility, and we have retained that. So in terms of something that we could use almost as bridging financing, we have 100 million available with a 50 million accordion there as well. So that gives us a little bit of flexibility. And then ultimately, you know, we're owned by shareholders. A large number of the shareholders have been with us for a long time, and their expectation and their desire is us to do value-adding acquisitions. So that would obviously be one of the other options, would be to speak to shareholders and ask for their support for deals as well. The other thing that we've been doing across the market is we're aware that for some portfolios, they probably more naturally point to some sort of partnership. So again, that might be another way that we would approach things, you know, working with a partner as well. So I suppose when we look at that variety of options that we have, that's why you know, we've got a good degree of confidence that we can execute things, both of that low to mid-sized deal, but also that we would certainly consider something that was more transformational as well.
I mean, say partnership, would that be sort of sort of joint venture, or would it be a case of you'd be interested in this part of the book and another person might be interested in another part of the book?
It could be a variety of things, Brian. Mm-hmm. And we've seen that historically with some UK deals where ultimately there wasn't one buyer for everything, and you had different people do different bits. So back in my career at Standard Life, for example, we worked in partnership with Phoenix to look at the AXA Wealth business, and Standard Life took the wrap platform, and Phoenix took the other parts of that business. So you could certainly see those sorts of things happening as well. So we're quite open-minded. We think we're a good partner, not least actually that for most people we're not a direct competitor as well. So that's one of the other things when we talk about being active in our conversations, that's with vendors, but also with potential people that we might partner so that they can understand we can do, and also the advisors that support companies, both corporate finance advisors and lawyers as well, just to try and put ourselves in the best possible position as and when things come to market, that people can understand the strength of us as a partner.
Okay, excellent. I'd like to turn briefly to new business now. So Sweden has clearly been difficult for the past couple of years. And when we interviewed last year, you spoke about a competitor that was aggressively pricing unsustainably. Have they removed that pricing now? Are things looking better?
Yeah, they have, and actually recently Dave and I were in Sweden to get a very full update on this sort of area. So that offer was withdrawn at the end of last year, and one of the things that we thought would happen was we would then start to see the very high transfer out rates that we'd maybe seen over the last 12 to 18 months start to come down. We weren't exactly sure where that would bottom out in, because we were conscious of we remember what happened after the RDR, where you started to see brokers and IFAs look more actively at existing customer books rather than just being focused on new business. So we were a little uncertain as exactly where that would trend down to. What we've seen at the half year and then since is that transfer rate now is down and actually slightly below the long-term assumption that we have in our books, which is good news and in line with kind of what we said to the market. As well as the offer having been withdrawn, I think the team have done a super job upping the retention activity that they have. And the other thing that they've been doing as well, as I alluded to in my presentation up front, there's some legislative changes that have come into the Swedish market in July that mean a broader range of books are now available to transfer out. all of our business was available to that pressure in the market. And now we're going to see some other people have some books that were protected and not available to transfer because of the legislation. They're going to come to the fore. So we've been trying to make sure, working with our broker partners, that we're in the best position possible to take advantage of that. And the early signs are there's at least some signs of optimism there, and we would hope that gives us the chance to improve the VNB a little bit more. Yeah,
it's probably worth adding for a little bit of background for people that Sweden has been progressively opening different chunks of business. So the chunks they opened a couple of years ago was basically what the sort of areas Chesnara is very significant in, and now they're moving on to other areas. So
no, that's right.
So quickly on solvency, which obviously is very strong because of the bond issue, and we all understand that solvency will decline to the sort of normal ratios over time as you do further acquisitions. You mentioned possible management actions, and I think this is something that maybe one or two investors, because people see Chesnara as a conservative company, and they quite like that in a lot of cases. And when they hear things like, "Oh yes, you're going to do management actions," does this mean you're not going to be quite conservative in the future? Or, what are you doing? I'll doing.
I'll maybe deal with the philosophy, and Dave can deal with kind of practically what he and the team have been working through, because he's been leading on a lot of this. What we said at the full year was you're absolutely right. I think Chesnara has been very conservative, and what we said is, look, we see the opportunities potentially to take the very off the front of that. So we can't envisage a scenario that we aren't going to continue to take a prudent and conservative approach, not least because that's what the Solvency II regime demands from insurers. What we've got to remember is the capital levels that we're holding are looking at 1 in 10, 1 in 20, 1 in 200 scenarios. So there's already a high degree of prudence built into the balance sheet. But we felt it was the right time to look again at certain management actions and things that might be available to us, just to ensure that we had that balance in the right place. And one of the things I called out at the full year was looking at our investment strategy. That was very, very conservative, and might there be some opportunities for that to change. And then Dave and the team have also been looking at what other management actions might look like. I don't know, Dave, do you want to give a little bit more color on that?
Yeah, it's interesting actually, because a good proportion of the management actions would actually, to some extent, de-risk the group. So you're right, Brian, we have been quite a risk-averse organisation, but we still, for example, don't reinsure that heavily. We also tend to not hedge. And things like hedging are generally seen to be kind of risk reduction programs. So there's two dynamics to the management actions. There's the investment side, and then there's the actions we can take to reduce the capital we've got to hold by de-risking certain areas. So an obvious one would be, we currently have a level of exposure to foreign currency because 2/3 of our business is in non-sterling, and we don't hedge that. So we therefore have to hold capital against that risk. One of the things we've always known is, were we to hedge that currency exposure away, albeit at a cost, we would be able to release all that capital we're currently holding against currency exposure. So I don't think there's a trade-off to, if people are concerned about the only way we can do these management actions is by becoming more risky, they would be wrong. Some of them actually, you get the cash benefit by becoming less risky.
And presumably these things, there's a delicate balance in terms of cost versus benefit. On the one hand, you talk about currency hedging, there's a cost to that hedging, but...
Yeah. Exactly. And it depends what which one of your financial levers is probably, the priority at a point in time. So the moment when we've got high solvency, incurring costs to hedge currency might be quite difficult. Another time, when you want solvency capacity to facilitate a deal, you might say, actually, the business case for spending the money now works. Mm-hmm. So there's never a right or wrong answer on things like hedging. It's about the circumstances at any point in time. But you're absolutely right; it's not free. So there's a value capital interplay.
Okay, well, it's good to know it's being looked into. So as I say, I'm conscious of time, so maybe we'll look to wind up. One last question might be, how do you see sort of outlook and prospects for sort of the next few months? I mean, obviously we've got we're in charge, perhaps slightly challenging economic circumstances. how do you see Chesnara progressing over the next few months?
Yeah, I spoke about this up front. I think, look, the business has got a really good track record of delivering in a very wide variety of market conditions. And actually the first year has been another good, I suppose, test for us in terms of the understanding that we have of the books of business in force. And very helpfully, it's one of the things that Dave and I have been discussing. They've moved almost perfectly in line with the sensitivities that we would have shown people at the full year. So that gives us confidence that we understand how these books react to a whole variety of market conditions, and particularly when they've been as violent as they have been in the first half. We also have good line of sight to cash generation looking forward. We talked at the full year about the various sources that we have that are available, and how they compare to both the dividend payments that we'd be expecting to make and the coupon. And that remains in a really good position. So when Dave and I are sat here today speaking to you, Brian, we have no concern about our line of sight to that cash generation. And then one of the things that I think investors had been asking us about, certainly over the last couple of years, was, is Chesnara still able to do acquisitions? Well, we've done 3 in the last year, and we're still seeing good opportunities to have those conversations. So we're absolutely conscious of the macro environment, which feels quite difficult. But against that, we've got a strong business. We're in a strong financial position. We raised that Tier 2 debt in February, and we think that gives us good opportunities going forward. So that's how we would see the outlook for Chesnara. I think we're in a good position to weather some of the things that might be thrown at us in the second half, and we've got financial resources that mean we can actually pursue strategic opportunities. So we think that should continue to be attractive for investors.
Excellent. That all sounds very promising. So if any listeners, viewers want to know more, we'll post links to the interim results and the slide deck from the interim results. And we'll also post a link to the research note that we'll publish once this is ready. Steve, Dave, thank you very much for your time today. We really appreciate you coming on.
Great talking to you, Brian.
And to all our viewers, don't forget to like and subscribe to our channel. We really appreciate your time. And we'll speak to you soon on Hardman Talks. Thank you very much.